Hello and welcome to my channel TJ the Tax Accountant. Please feel free to subscribe to my channel to learn more and more about basics of tax accounting. Our topic of discussion for today is what is valuation allowance. So by definition, valuation allowance is a reserve on your deferred tax asset which reduces the value of your deferred tax asset to a more realizable value in future years. So you can understand valuation allowance in line with a bad debt reserve against your receivables. The future realization of deferred tax asset is based on the sufficient taxable income available in future years to set off the deferred tax asset. And the evaluation of valuation allowance is always done after you have reduced your deferred tax asset by any uncertain tax position. So moving on to the steps to analyze the need for valuation allowance. So the first step is to evaluate whether a valuation allowance is even required or not. Second step would be to determine the amount of valuation allowance that is required. And the third step would be to prepare journal entries to record your valuation allowance in your books of accounts. So we'll talk about these steps to recognize valuation allowance in detail. So the first step of evaluating the evidence for determining whether a VA is required or not. So there are four sources of positive evidence, and these are listed in the order of weightage you need to give to each of these factors. So the first and foremost factor is the taxable income in prior year for any carryback or taxable income available in future years for set off of any of your deferred tax asset. So if a business is earning losses and is not expected to make any earnings in or positive earnings in future years, then even if you have other factors in your favor, you would still have to record a valuation allowance against your deferred tax assets. So the second factor to for evaluation is future reversal of any existing temporary differences that are on your books of account. Third one would be any tax planning strategy. So your business might be in a loss situation now, but due to some tax planning strategies, there could be income coming in to your entity, which can be used to support future realizability of deferred tax asset, and hence a valuation allowance can be avoided. And the last is the future taxable income. You may have to rely on business forecast to predict the future taxable income of your business in order to support whether a valuation allowance is required or not. So just to illustrate it further, so you can see in this picture there is a reversal of deferred tax liabilities in future, which is a favorable evidence to not record a valuation allowance. However, in this example, all the other factors like sale of assets creating a deferred tax liability in future, or carryback period is short, your prior 3-year cumulative income is negative, or there are no NOLs to be carried back, or future income from customers that is expected. So those customers are having bankruptcy or liquidity issues. So these factors contribute as a negative evidence. So the negative evidence outweighs the positive evidence, and hence in this case you may have to record a valuation allowance against your deferred tax assets. So moving on to the measurement of valuation allowance. So in the example on your screen, you can see in year 1 the business has made an income of 100,000. In year 2 the income is 200,000, and in the current year they have incurred a loss of 800,000 US dollars, which means that the 3-year cumulative income of the entity is a loss of 500,000, which is the primary factor for recording a valuation allowance, and thereby it outweighs any other factor which may support to not record a valuation allowance. So for the purposes of this example, we'll calculate the amount of deferred tax asset at 200,000. So we are assuming a tax rate of 25%. And because our current year loss is 800,000 times the tax rate of 25%, it creates a deferred tax asset of $200,000. However, for the valuation allowance purposes, we would value uh, the, the future deferred tax assets. So in this example, we are assuming that out of the loss of 800,000 in current year, 300,000 worth of losses being carried back. So my net DTA is 500,000, which is being carried forward to be used in future years. So my valuation allowance always looks forward, it doesn't look backward. So because $500,000 worth of loss is something which I'm going to use in future years, so 500,000 times 25% gives me my valuation allowance of 125,000. So a quick look at the journal entry for recording valuation allowance in this case. So you would first record the deferred tax asset of 200,000. So you would debit your deferred tax asset. You would credit your deferred tax expense by 200,000 to record the DTA for the NOLs, and subsequently, in order to record the valuation allowance, you would debit the deferred tax expense and credit the valuation allowance for the amount of 125,000. So the net effect of these two journal entries is a benefit of 75,000 US dollars on your deferred tax expense, which is the $300,000 of loss which was carried back times the 25% tax rate, hence 75,000. And on your balance sheet, you would see your deferred tax asset being reported as 500,000, and then you would see a reduction in form of valuation allowance of 125,000 and a net DTA of 375,000 on your balance sheet. So I hope this little video will be helpful for you to understand the basics of valuation allowance and how does it work and how to recognize it, and what kind of journal entries are required to book the valuation allowance, and the factors that you would need to consider when you are looking at your valuation allowance which is booked in prior years, and then you're looking at it in the current year, whether to continue with the valuation allowance or to release it in the current year. So you can go over the factors that determine the valuation allowance. Please subscribe to my channel. I have some more topics that I have lined up, which I will be posting in near future on this channel. So I'll be discussing the uncertain tax positions. I'll be discussing some of the book tax differences, the basics of book tax differences, the permanent differences, temporary differences, and how do they impact your effective tax rate. So please do subscribe and hit the bell icon for getting an alert whenever I post a new video on my channel. Thank you for listening. Bye.